and potential investors about investing into the futures marketplace. What misconceptions of investing in the futures marketplace, or just investing period, by investors have you typically seen?
Well, I would call it more CTA type investing. I think when you invest with CTAs, you should do that. Put 4 or 5 CTAs into your portfolio, even if they're all trend following. I think that's fine. But I think that when looking at this as an investment, people have a tendency to think that stocks somehow are superior to this strategy, and I don't think that's the case. The stock trends that I've seen over 35 years are no better or worse than the commodity trends, bond trends, and currency trends. So there's really no opportunity cost or loss for diversifying. It really is a free lunch, and a good CTA investment can make that possible for you. Of course, most people will recommend a 5 or 10% allocation of your portfolio to CTAs, but we build the fund and the program to put all of our money in it, and it's what I would consider to be the perfect portfolio, and not just the perfect portfolio hedge. Now, recently, of course, stocks do look like they are very superior to CTAs and in the markets, other markets that we trade. But over the short term, of course, this can happen. But I think in the long term, it is a great, safe investment. Even though futures may have sort of a scary term, be a scary term for some people, we're pretty well schooled on taking small losses and following the trends and diversifying. And you really can't, in my opinion, get much safer than what we do.
Okay, well, Jerry, thank you. We need to take a break here. When we come back, let's talk about the differences you see between trading today and trading when you started Chesapeake in 1988. Again, we're talking with Jerry Parker, founder, chairman, and CEO of Chesapeake Capital. Again, one of the original turtle traders. You're listening to Strategic Investor Radio and OC Talk Radio, and we'll be right back.
All right, time for our tip of the week. What do you have for us today, Charlie?
Thank you, Paul. We're talking with John Kosar, Asbury Research. They provide research reports and market signals to subscribers. So, John, we're in July, and that's kind of in the middle of sell in May and go away pattern. What pattern do you see going forward? What kind of advice do you have for investors?
Well, this is one of the most interesting times of the year if you're looking at seasonality. And keep in mind, seasonality is simply statistics. We look at a certain asset, whether it's stocks or bonds or whatever it might be, and we see if during certain times of the year you might see the price of the asset go up or down. So the first 2 weeks of July, which just ended, are seasonally the 2 strongest weeks by far of the entire third quarter in the S&P 500 based on data going back 60 years. From there, seasonally, again, this is 60 years of data, and it's on average, you get a progressively weaker S&P 500, and that weakness actually accelerates through Labor Day and into the end of the month. So things really start to turn south statistically once we get into September.
What do you think that means for investors? Do they sell, or are they just more careful? What does it mean for them?
No, I would look at this as a blinking yellow light on a dark road rather than a stop sign. We tell our clients is when you know there's a seasonal tendency for a certain asset to do something, take stock of what you have. See what indexes you hold. Are you holding the S&P, the Dow? And ask yourself the question, should something turn south here? Should something turn the market where it starts to go down? Where do I want to get out? Or what do I want to put in place so I'm not making a decision when the pressure's on and I wake up some morning and the S&P is down 15 or 20 points or something geopolitically happened. So this is when you should really look at what you have and have an escape plan. Hopefully you don't have to execute it, but this is when you should be planning for the worst and hoping for the best.
So, John, excellent advice. For those who would like to know more, where can they go?
The best place to reach out to us is go to our website. It's ASBURYresearch.com, ASBURY research.com. There's a contact tab there. Send that to us right from the website, and we can offer you some sample copies and give you a little bit of information about what we do for subscribers.
John, thanks for joining us today, and congratulations on that new granddaughter.
Thanks, Charlie.
And now back to Charlie and his guest.
Thank you, Paul. Again, we're talking with Jerry Parker, founder, chairman, and CEO of Chesapeake Capital, one of the original first-term turtle traders, and has been a CTA with his own firm, Chesapeake, since 1988. So since 1988, Jerry, the world has gone through a ton of changes, primarily through technology. What differences do you recognize and see today between trading in 1988 and trading in 2017?
Well, in 1983, 84, we started with, we probably traded 25 markets, mostly commodities and a couple of bonds and a stock index. And then fast forward to 2017, we're trading 100 markets, lots of bond markets all around the world, currencies, and a few more commodities, I would say.
Do you like that better? Is that an improvement, do you think, for the investor?
Oh yeah, of course. That's going to keep the volatility a little bit lower. Even though a lot of these markets are sort of correlated, it's still better to trade them than not trade them. And yeah, so I think that's a big positive. I think on the negative side, there are a lot of traders, computers, trend followers, people who are trying to take advantage of trend followers and the trend. And so the markets are, let's just say, choppier and more whipsaw. And so you'll get a long-term trend that may last for a year or two, but it's probably not going to be as smooth, straight-up shot like it would have been in the 70s and 80s. So I'm sort of paid to navigate that and figure that out and stay in and be long-term enough to not get knocked out. But then when the trend reverses, I can't be a pig and stay too long and lose, because some of these reversals can be pretty violent, and you can give back a year's worth of profits in a few weeks if you're not careful. So it's some pros and cons. Obviously, electronic execution and commissions and slippage, and all the cost of trading is lower these days. Competition is tougher, but certainly longer term is short-term trading like we used to do in the turtle years, and so in my opinion, sort of stopped working in the late 90s.
So you're trading more longer term these days?
That's right.
Okay, so what could we say is the typical or average staying period for your positions?
So I would say about a year. Some of these trends have a tendency